I don't understand why US businesses drive so much towards making their stock owners happy. It's a delicate balance that many forget in the chase for short-term gains. Shareholders wield significant influence because their investment choices steer the company's direction. They are not just passive income collectors, they are actively involved in shaping the company's future through their voting power. Giving too much weight to short-term stock price increases can lead to decisions that undermine the company's long-term health. When push comes to shove, a company with a solid foundation, a skilled and satisfied workforce, and a strategy for sustainable growth often translates into a more reliable investment. The astute shareholders and executives know that the heart of a great company isn't just its profit margins, but the value created for customers, the innovation developed, and the talent it manages to retain through its ranks. Those who manage to strike the right balance between these factors and profit-seeking are the ones likely to thrive in the long run, much to the benefit of everyone, shareholders included. That is the point of the business existence, to make profit for the owners. Undoubtedly, the shareholder paradigm dictates that profit maximization takes precedence in the corporate strategy. However, an intellectually myopic focus on short-term gains can inadvertently sabotage the very profitability it seeks to enhance. For instance, CEOs mercilessly cutting costs via layoffs risk gutting the company's operational effectiveness and innovational potential. Severing the workforce to pad quarterly reports might temporarily spike stock prices, but it's essentially cannibalistic. Ultimately, you're devouring the company's future for fleeting satisfaction. True visionary leadership balances the need for shareholder value with sustainable, long-term business health, nurturing an ecosystem where employees, and thereby the economy, thrive alongside the share's value. After all, a malnourished tree bears no fruit. A business sans a skilled and motivated workforce is equally barren. Shareholders eye dividends and stock value, but ignoring the symbiosis between employee well-being and company success is a myopic strategy with the potential to derail even the most profitable corporations. Owning stock literally means owning shares of the business. You're asking why businesses drive to make the owners happy. Incorporated businesses are legally obligated to make decisions that benefit shareholders. The board of directors appoint executive officers, i.e., CEO, CFO, etc., and all of these directors and officers have a fiduciary duty to shareholders, and if they act against the interest of the shareholders, they can be held personally liable, i.e., they can be sued. I don't get it. A business doesn't make decisions. People make decisions. People with a financial interest in increasing the stock price. The stockholders are part owners of the business and may have some significant say on how it is run. Executives are also compensated with stock, which they can then try to make more valuable. Everyone involved has an incentive to focus on maximizing short-term profit. The executives of the company are appointed by the board, and the board is accountable to the shareholders who more or less only care about the stock price. Stock owners are the boss when the owners are separated from the workers. This is what you get. The shareholders are the owners of the company, and as the owners they have power over how the company is run. When it comes to making major decisions, one share of stock is usually worth one vote, and those votes are used to do things like hire fire C-suite executives. To normal retail investors who maybe own a dozen shares or so, they obviously have no power. But major investment banks can control major minority stakes in companies which can be leveraged to influence how the company is run. If JP Morgan owns a 30% stake in your company, for example, and you as the CEO piss them off somehow, there's a very real possibility that they can call a shareholder meeting to have you fired as the chief executive. That's why they care about investor relations so much. Stockholders are the owners. The goal is to make money for the owners, anything else is nice to have. Companies have to act in the best interest of their investors. Fiduciary duty. People who own stocks equals owners of the company. Even if you only own one share, the owners are going to do whatever it is to maximize profits, right? Dodge vs. Ford Motor Co. plays a part here, besides the other answers that have been given already. Corporations are required to operate in a profitable manner. https://n.m.wikipedia.org wiki.dodgev.ford Motor Co. Because the stockholders are the owners, they can elect the board. If the board causes the stock price to fall too much, the shareholders get upset, vote out the board, and elect a new board. The problem is that most people are only concerned with short-term profits at the expense of long-term gains. So what if you kill your company's reputation? You made money this quarter by putting out an inferior product. Stock gives two benefits to their owners: either they give dividends or regular payout from the company, or they give voting rights in shareholder meetings, or both. The shareholders' meeting is the top deciding organ of the company. It is they who determines the board of directors. The shareholders are the owners of the company. Seems to me that keeping people employed to spend the money they earn back into the economy is more important than the stock price pumping too for your shareholders. Sounds like you have found one of the big issues with private capital. I believe it's the law that the board of directors of any publicly traded company strive to make the company profitable. People start businesses to make a profit and to make a living. Stockholders are the owners of the business. It exists to make them money. Yes, along the way, many companies do good things for workers and the community as well. But every public company has analysts that rate the company on how well managed they are and how much money they make for investors. Investors, including 401k holders, invest in companies that make the most money. Those investors demand a certain margin depending on the industry and risk profile, or they withdraw their money and invest elsewhere. If businesses don't maximize shareholder returns, they go out of business. Businesses are not charities with a public purpose, they exist for the primary reason of generating returns for investors. Because that's what the law requires them to do, protect shareholders. The owners of the stock shareholders are the owners of the company. They have a share of ownership. The company management are literally paid to look after the interests of the owners. This is true whether it's a contracted manager at a mom and pop store or the CEO of a Fortune 500 company. Because many have their retirement funds tied to the stock market, there's a vested interest in ownership there. I don't think you understand what stocks actually are.